All right. Thank you all for coming in this early, bright, and getting ready for the snowstorm. Let me start with the opening statement for our meeting. The trustees of the Boston Public Library reaffirm our commitment to racial equity and to principles of diversity, equity, and inclusion more broadly. The library is formally committed to becoming an anti-racist organization in response to systemic racism, inequity, and injustice prevalent in our society. We acknowledge also that the Boston Public Library's Central Library stands on land that it was once a water-based ecosystem providing sustenance for the indigenous Massachusetts people, and it's a place which has long served as a site of meeting and exchange among nations. We are committed to land acknowledgements for all our locations to which we operate. We have reaffirmed this commitment to set the context of our planning deliberations, and public engagement will take place from the spirit of welcome and respect found in our motto, free to all. We're going to start with the roll call. Give me a second. We'll have approval of the minutes. We have the portfolio review. I know that you're all excited to listen about what's going to happen in the market and the crystal ball. And vote. We have a vote. We're going to review the tax returns and then new business. So with that, can we get a roll call?
Yes, I'm just going to read your last names. Arana Ortiz.
Present.
Bao.
Here.
Tyler. I can see you, John.
If you can believe it, I'm on mute. I must be with my,
Thank you.
what I was thinking, me on mute. Go, guys.
I know that Jeff had a conflict, so he is not able to attend. Leonard.
Here.
And Rush.
Here.
We have a quorum.
There you go. All right. Can I get a motion to approve the minutes?
So moved.
Second.
All right. Any questions? Any comments? No. All right. Can I get a vote?
You can do.
I'll do any abstentions? What is the other one? Abstentions?
Any nay? No.
Any nays? Okay. All right.
Everyone approved?
Everyone approved.
Is that a yay?
Yes.
Yay.
Yay.
All right.
Yay.
Lift your hands. There you
Thank you. So moved.
go. All right. Sebastian, talk to us about this soap opera that we're living in. Go.
Before you start, Sebastian, can I just make a note for the record that this meeting is being recorded and that if anyone in the public would like to leave public comment, please do so by signing up via the chat by 9 a.m. And Sebastian, if you need any of your slides forwarded, Jay is on the call and you just need to say next slide. He'll move it.
Okay, perfect. Well, good morning, everyone. Never a dull moment. I feel like every time we meet, the world imploded the weekend before, and we get to figure out how we move forward. Obviously, the situation that occurred this weekend is a bit fluid, right? It's something that perhaps was occurring under the covers, if you will, but the speed at which SVB and some of these other banks over the weekend were taken over by regulators is a bit unprecedented. I think a lot of what you saw was really a way for them to stem any type of reverberation or contagion, if you will. So a very heavy word throughout the system. I think you probably received a note from us yesterday in our team, but we do believe that with Signature Bank, with SVB, these were somewhat isolated incidents and really tied to their own asset liability management, meaning that the bonds that they were holding or that they were investing their deposited monies in, as there were requests and increased requests for withdrawals, they simply had to sell those assets, and they were selling bonds that were yielding sub current market returns in order to fulfill those requests. And as a result, you saw the extent of the sell-off that you saw. The Fed, the FDIC, the Treasury coming in and really, I think, stabilizing the situation was quite helpful, and you saw that come through yesterday. And all eyes are really on the inflation print today and what the Fed does next week. So a lot of the information that you have here does tie into that discussion, right? Because if we were just talking a week ago, last Thursday, or last Wednesday, last Tuesday, the question would be, okay, well, it looks like all of the information that we're seeing economically is still supporting further rate hikes. And there was really a 50 basis point hike on the table. And I think for all intents and purposes, 50 is likely to be gone right now. But there's still a likelihood that we will see a 25 basis point increase, depending on what other information we see here today. I don't think we'll see a situation where the Fed pauses or does nothing at this meeting, but there may be a situation where on a go-forward basis, we see a little bit of a pullback and a pause just to see how this all flows through. So that's really the high-level overview of what's happening. In terms of your portfolio, when we think about the asset allocation, the approach, the strategy, it's very much...
Sebastian, real quick, sorry to interrupt, but just to follow up, I think the big question now is what does the Fed do with rates and how does that kind of our portfolio? So it's kind of tied in right with that. So before you start on the portfolio, maybe just explain why people are wondering what's going to now happen with the Fed, and they just dictated out a policy that they're probably going to be changing on. So that might be helpful.
Sure, and that's what the market is looking at today. So if you're seeing, if you looked at the journal today or any of the websites that show you futures, they're slightly positive. The hope is that the inflation print comes in lower than it did come in last month, and that with some of the other news that's come in, particularly this last week. So let's just take a step back, right? What did the Fed do? The Fed is trying to lower inflation by increasing rates, by slowing down the economy to such an extent that we start to see that inflation print ebb, rates start to converge with inflation, and that's the inflection point that they're aiming for. The point of doing all this is that you slow the economy enough and slow demand enough without putting into a recession so you have a soft landing. That's sort of this perfect approach to what their approach is. Inflation has been stubbornly high. So even though the core number has come in, so we started to see a 6 handle, I think 6.4 was last month. I think there's an expectation that it might be 6 today. If you peel back the layers of what's happening underneath all those numbers, particularly something the Fed calls super core inflation, like what are you paying at the barber shop and these types of costs, that has been stubbornly high. Unemployment has been stubbornly strong in this instance. So you want to maintain max unemployment, and wages have been stickier as well. So you have this sort of push-pull dynamic, which is causing the Fed to stay higher for longer or to increase to continue to stem that off. With the situation that happened this weekend, with the Fed having to step in, typically in a normal environment, I should say normal in quotes, and this is hypothetical, if we had something like this happen and we had lower inflation, the likelihood is that you'd see any type of Fed activity either pause or get additional support. Unfortunately, we're not in a position where we would see the Fed sort of pull their foot off the gas pedal today from the hawkishness that we've seen from them, because they're still trying to stave off this broader economic inflationary environment, while also making sure that the situation that happened with SVB and Signature Bank and the others this weekend doesn't transform into something broader. So now it's sort of it's a very delicate balancing act. So as we look forward, as I mentioned, the Fed, the expectation was that we were going to get probably a 50 basis point rate hike in the next week, which is likely off the table at the moment. The discussions are now whether we'll see anything, and if we don't see any move, what message does that send to the market? Or if we see a 25 basis point hike, and how that flows through to further hikes. Because when we were talking, if we were talking about this last week, the view was that we were shifting to an environment where the Fed was going to continue on this path, albeit slower, but it was going to be a higher for longer type of approach. With everything that's happening today, the question then becomes now, what is the path of rate hikes or future rate hikes? Are we going to see something where there's a pullback at some point this year, where I think the market has basically discounted that was going to be something that we'd see in 2024 at this point? And how does that flow through to everything that we're seeing? Because to an extent, the the moves that occurred over the last 12 to 18 months, going from in effect 0 policy to 4.5% rates in such a short period of time, certainly factors into everything that we've been experiencing, right? The cost of capital, all of the cost of doing business has increased. What you're seeing as a result of the sale of lower yield assets to try and raise capital, all kind of flows through this. So, these are all intertwined. So I think for us that's the big question on a go forward basis is, what are their next steps and how do they kind of weather this sort of uncertainty that we should likely expect here over the next couple of weeks. So I know, John, that's not a direct answer because there's so many corollaries to what could happen here in the very near future.
I think that example of the unknown there right now. So that's a great response to an unknown answer. So thanks.
I tried watching a little Bloomberg this morning. They helped me out.
That's because you knew that John was going to be in the meeting.
Well, of course, it's always a good discussion. But those are the unknowns, right? Heading into this year, and you saw some of what we were talking about in our materials. Last year was clearly a volatile year. And if you think about what caused a lot of the sell-off, it was tied directly to rates. And you basically saw valuation declines as a result of the rate hikes. What we were focusing on this year is that you started to see some pressures from an earnings perspective, right? You started to see some pressures from companies right sizing, especially in the tech side, from an employee perspective. You started to see really some of these more fundamental things working themselves through. So the situation that happened really exacerbated a little bit of that. And the expectation from us for this year was that the Fed was going to continue on this path. Peak rates had increased from the market thinking it was going to be 4.5% to closer to 5%. I was watching the news last week, and Stifel, which is an industry firm that really kind of puts up their thoughts out there as to where the Fed is heading. Just a week or two ago, we're thinking that peak rates were going to hit 6%, which is huge from where we are today, and how far and how fast the Fed would have had to move to get there. So, where do we get there ultimately? That's the question mark. Obviously, a lot of the factors that are flowing into it today are going to be the ones that are going to dictate a bit of that. The big and key focus for today will be, where does inflation come out? Well, and it just came out at 6%. And how the Fed now reacts in the next week. So we'll have a lot of data coming out in the next week that will likely drive some sentiment in the market. So with that, maybe just taking a step back because a lot of uncertainty out there in the markets, and that does cause some opportunity, but also wanted to make sure that we remain disciplined when we think about asset allocation, rebalancing, and the like. One of the things we wanted to give you is just a highlight of NEPC. And the reason we wanted to bring this to you is really what we wanted to share and reaffirm and reinforce with you is that NEPC is still the same firm that you started working with a number of years ago as it is today. We continue to be 100% employee owned, continue to reinvest in our business and reinvest in making sure that our clients and partners really meet their missions and goals and objectives through their investment programs and beyond. 2022 was a tough year in the industry as a whole, but the top half of this page really shows you that even in the face of some uncertainty, the firm is on strong footing. We have increased the number of clients we work with, but it's really a methodical approach. We really want to be mindful of how many clients all of us work with. We increase the number of employees we work with, and that's really across the board. So Evelyn, you had the DE&I and impact comment on the Boston Public Library to start off the meeting. If you think about, or if you look at the number of folks that we hired and the number of diverse additions that we've had, it's been quite significant to the firm. So it's something that's a source of pride for NEPC, and assets are stable. So that's something that I think is a truth and testament to the partnerships that we build with clients are meant to be long term, as we think that helps achieve long term success. On the bottom half of this page, I won't necessarily go through this, but just the left hand side, the NPS score, Net Promoter Score. It's a question that's asked of individuals whether or not they would recommend you work with the company, and it's on a scale of -100 to 100. Basically, it's a yes or no type answer, and getting a 74.2 is something that we're very proud of, because I think that shows the support that we have from the institutions that we work with. And if we just flip 2 pages ahead, one of the things that we did want to make you aware of is that we are having our annual investment conference in Boston on Tuesday, May 9th and 10th. It is just right in the seaport. If you are interested, you will be receiving a formal invitation from us. And if you're available, we'd love to have you. This is purely NEPC clients that are invited to this, along with folks like myself and others from NEPC. The keynote speaker this year is Howard Marks from Oaktree, a very well-known investor. It's a great event. It's a great event to network. It's a great event to learn. There's a number of topics that will be discussed that perhaps we're not pursuing with the endowment, but are of interest to you. So if you're available on those days, we'd love to have you. So with that, why don't we move to the portfolio itself? And perhaps what I'll do is start on page 6. So 2 more, if we could. Just 1 more. Perfect. So this is the report for the endowment through January 31st. So we do have January numbers here. February will take a little bit of this back, but you'll see that January did start off on a very strong foot following a challenging 2022. When you look up and down the line, really you are seeing really strong performance throughout. One of the reversals that we did see during the month is that growth was back in favor to start off the year, and really it goes back to the discussion we were just having with John asking the question, what does the Fed do? There's this real view that inflation is coming in. The Fed may not need to move as strongly as the expectations had been. And you really saw that support some of those assets that had sold off last year. Clearly, that's moderated since then. But I think on the whole, the good takeaway from this page is whether it was equities, whether it was fixed income or multi-asset, we saw a very strong bounce back off of a challenging 2022. To foreshadow one of the recommendations that we'll be talking to you about in just a little bit, and it ties back to the last meeting we had, we do see some opportunities to trade risk off, meaning that the risk premium that's been associated with between equity and fixed income has shrunk, and we think there's a way to maintain attractive returns while actually reducing equity risk in the portfolio. So we'll talk to you about that in just a moment. So I'll stop there just to see if there's any questions on January, and then we can jump into really our market outlook themes and the asset allocation discussion. Okay, so if we can, perhaps we move to page number 14, and I saw that perhaps the page numbers aren't coming through clearly, but it's titled 2023 Key Investment Themes. There we go. Perfect. Thank you. So as a firm, on an annual basis, we meet at the beginning of each year to set what we think are the themes that will drive the market for the coming year. And as I mentioned, one of the unique things about this year was that we saw this confluence of events that we haven't seen in quite a bit of time. And the trends led us to think through, have we seen a corollary in markets historically to what the Fed and the economy as a whole is experiencing today? That led us back to the late 70s, right? We are seeing inflation that is stickier. We are seeing rates that are higher and likely to be higher for longer. We are seeing some of these trends that we saw back in the 70s, but we don't think we're in a stagflationary environment. I think there are trends that we will be working through, but there are items on the opposite end of it that are counteracting some of this, like the unemployment numbers that I mentioned to you. So this will all be in focus really in the next, couple of weeks, couple of months, as we see how the Fed pivots to the current environment and really how the market reacts. Right, a lot of the data that we're seeing is on a bit of a lag. So what we've seen happen over the course of next week, we'll likely see reverberate through some of the numbers coming in next month, and seeing what we need or what the Fed needs to do on their end to continue down the path that they have been. And stagflationary trends do tie into the recessionary outlook, because regardless of who you ask and what their probabilities are for a recession, there is an expectation that we do see some type of a slowdown in the economy, whether it's later this year, whether it's at the beginning of next year, simply because of all of this working itself through the system. As I mentioned, last year was really a valuation story in terms of the market pullback. This year is a bit more of a fundamental story in terms of what you're seeing working itself through. And that's what we'll be looking at, particularly as we see the rate moves, not only in the US, but globally. Central banks have sort of been coordinated in terms of what they've been doing to battle inflation. And how that kind of plays itself through. So there is a challenging environment here ahead of us, we think, all else equal, even with what just happened this past weekend. When we look overseas, especially in Europe, if you kind of think about what drove inflation in the US was very much supply-demand driven. What drove inflation in Europe was very much a result of the Ukraine-Russia war and energy driven. Energy prices really flowed through and increased costs across the board, and you saw that type of inflationary environment. While that poses a challenge in the near term, over the long term, we think that what you've seen in the last year in that pivot away from Russia as the main source of supplies to Europe, that pivot away towards potentially moving towards more renewables, more transitionary energy supplies is underway in Europe. And over time, that will present a very interesting opportunity, I think, across markets as we see that kind of move itself through. For now, though, clearly, the milder winter in Europe has really helped the continent through what would have been a very challenging environment. But as they look forward, they still have to consider, the future state of their energy infrastructure and how they've diversified the sources and supplies of what they need. So there's more to come on that, but it's likely to offer some opportunities on a go-forward basis. And the last one I'll touch on here is just this China reopening. So if we kind of think about where Europe, US was from a COVID reopening situation where we were a year ago, people were flush with cash, people were flush with demand. They wanted to get out there, they wanted to travel, they wanted to spend on goods, services, etc. China pivoting from zero COVID to fully open, in effect overnight, is resulting in something similar with the Chinese population. And you're seeing demand for travel. You're seeing some of the same things that we saw in the US, albeit delayed by about a year and a half. And really the question mark there is how does that play through from an inflationary perspective? Because that demand for goods, services, et cetera, from a very large population center in the world can at least temporarily continue to drive that through. So what you're seeing is the themes really converge around a couple of items. It is around rates, it is around inflation, and there are some underlying geopolitical trends too that can factor into this. So a lot of question marks out there, which is why in this type of environment, we think that the discipline around maintaining that strategic asset allocation is key. So what you'll see from us is we're not recommending any changes to the strategic approach, as we do think it's appropriate, but we are recommending ways to, from an implementation perspective, to not limit the potential return of our portfolio, but perhaps take a little bit of the risk off. So I'll stop there just to see if there are any questions.
None for me.
Okay.
Anybody else?
Nope, just good. Yeah,
Thank you.
These are kinds of the big highlights. I guess the big one though is, which causes kind of some of the issues and battles going up, is this relationship between China and the US and how that begins to expand into certain industries, which it already has. Do you see that becoming more problematic for the global economy, or is it kind of off to the side and more political than economic?
I think you have a little bit of both. Over the last 30 or 40 years, we've sort of seen this globalization trend work in the favor of the consumer, right? Costs reduced on products, on goods. This is just-in-time approach where, we were getting all of our goods from certain regions around the world, and the costs of such were lower. And I think over the last 2 years, what you've seen is really a pullback from that. I don't want to call it deglobalization, but certainly more of a looking inward around the globe. And the term nearshoring has sort of popped up as, companies, firms, industries move away from those traditional manufacturing and commerce centers and bring things closer to their shores. The other part of this is there is some politics to it with the CHIPS Act and some of these other things that really can cause a little bit of uncertainty in some of these industries. On the whole, all of that is more inflationary in nature, because moving from a low cost center to maybe a mid or higher cost center obviously gets translated to higher prices, right? So I think, what you will see there is that, there is some inflationary pressures to it. The second part of your question, the geopolitical one, that's going to play itself through, and that's the harder one to answer, right? It's you can look at it as, what's happening in the war with Ukraine and Russia, and are we at a stalemate there? How do other countries and actors factor into that? Obviously, there are tensions between Taiwan and China. There are tensions in other parts of the world. So there are a lot of these micro geopolitical things that are also happening. And you hope that cooler heads prevail and dialogue wins the day. But at the moment, from what we're seeing, it is a bit status quo in terms of the situation. Can that change? Obviously, it can, hopefully for the better. But those are the tougher ones to really try and guess as to, what's next from that perspective.
Great, thanks.
Sophie, move to slide 19. Some of the slides that precede this are ones that I touched on. We are in a little bit of a different environment today. Oh, one before this. We are in a little bit of a different environment today than we have been in the past, in that the 40-year bull run that we've seen in bonds is behind us, right? And today, bond yields are offering a very attractive return where they haven't for the last very long time. And really what that does is, when you think about it from an asset allocation and an asset class perspective, is that it tilts the favor of asset allocation more in the favor of bonds versus equities, simply because the risk premia, as I mentioned earlier, starts to shrink, and you see that balance over to bonds. So a balanced portfolio of stocks and bonds today is significantly more attractive than it would have been 5 or 10 years ago, where bonds were earning zero and you needed to take on that equity risk or take on risk assets in order to earn that return. And I think it's very evident here just on this page. There are a lot of numbers, but if you focus on the bottom half of this page, when we went through this exercise with you a year ago, this portfolio had an expected 10-year return of 4.6%. If you look at it today, it has an expected 10-year forward-looking return of 6.3%, which is a significant increase year over year, largely driven by that bond piece. Equity expectations have also gone up because of the sell-off that we saw, but I think this is where that balancing act comes in. When we look at the underlying components of what you own in this portfolio, or how you're structured, what we try to do is balance. Not only is it balance just between equities and fixed income, but there's balance within equities and fixed income. And what I mean by that is, if we look at the equity allocation as a whole, our base case is that we want to see how the global equity market looks like regionally, and then make tilts relative to that. So what I mean by that is, when you think about the global equity economy or the global economy, we look at the MSCI ACWI benchmark, which is sort of a global S&P 500, if you will. And if you look at the underlying components of that regionally, Roughly 60% of that is US, roughly 25% of that is non-US developed, so Europe, Japan, Canada, and the rest is in emerging markets. So that's always our base case, not that weight, but that benchmark is always our base case in terms of how we want to be positioned. Today, and really over the last couple of years, we've been favoring a slight overweight to the US. We've been favoring a slight underweight to Europe and developed non-US, and a slight overweight to emerging markets. And that's really how you see this allocation positioned here today. On the fixed income side, it's a little bit of a different story. We're looking at yield versus high quality or safe haven assets. So what we're trying to do is balance that out within fixed income. We want to have assets that can add yield to the portfolio, and that's the form of the global multi-sector, and to an extent, actually the PIMCO All Asset Fund. Then we also want to have assets that are safe haven assets, meaning that, you know, in the event of a sell-off or in the event of market pressures, these are assets that can provide liquidity if we need it, and they provide safety. And that's what you see across the top three: US TIPS, Treasuries, and the aggregate bond allocation that we have. So we think from a balance perspective, we're in quite a great position on the whole, which is why we don't think we should be making any changes today from a strategic perspective. The one recommendation that we do want to talk to the committee about is on the following page, which is page 20. And we had talked about this a little bit at the last meeting, in that what we've seen is, even with improved return prospects within equities, because the premia has shifted, what we've looked at are ways to not give up return, but remove a little bit of the risk from the portfolio. And the trade-off has been that we view short-term investment grade credit. So this is high quality corporate debt that we're talking about. So, you know, what companies are in this index that you see here? You know, Boeing, AbbVie, Bank of America, very high quality, well-known, established businesses. And we're not taking on duration risk with this type of an investment. It's short-term in nature, meaning that it's really sub 5 years in maturity. And I think actually the maturity on this is closer to, it's about 2.7 years in duration, meaning that it's very short in terms of the overall underlying life of the investments this index is making. But what you're seeing is that you're earning a very attractive yield north of 5% today to take on this this type of position. So what we've been telling clients is that, you know, today what we would be the way we would be positioning is that we would take some equity risk off the table. So if you have a 60% target, we'd say, let's bring the equity exposure to 57%, and let's take on a higher quality corporate bonds as sort of that proxy for equity risk. And it's actually worked out quite well throughout 2022. And I think it's a position that continues to be attractive today. So when you look at what that means from an exposure perspective or from an allocation perspective on page 2020, not on page 2022, on page 22, you'll see that that equates to approximately a $1.8 million position, or about 3%, which would be within or sit within the fixed income allocation, but would be funded from sources that are considered riskier, i.e. the Manulife, the multi-sector allocation, which is a more yield-seeking total return type of approach, as well as through a rebalancing of the equity portfolio, which also ties into the annual draw from the endowment. So there, I know I've said a lot, so I'm going to take a step back just to see if there are questions around this or anything around asset allocation or otherwise.
Yeah, I'm sort of absorbing this one. So you're saying add a new fund, the Vanguard, and the UBS emerging markets.
And that's a little bit of just rebalancing.
Right.
That's to get us to closer to target. So this is trying to achieve three things on this page. One, we, based on the rolling average, the 5% spend, we have to raise approximately $3.9 million today. So since we have to raise those assets, and we've been talking about potentially looking at adding the short-term corporate debt, if we move forward, this would be the rebalancing recommendation to get there. What we end up doing here is we get back in line to our target allocation. So regionally, that also flows through. We bring the emerging market allocation closer to that target or closer to that weight that we need to. And then on the whole, we shift a bit of the risk of the portfolio by adding the Vanguard short-term corporate bond here as a substitute for some of the risk exposure we have in the portfolio.
Okay, I was trying to figure out why the math was not working for me, but
So the 3.8 million is just the net of all the numbers, or 3.872.
okay.
Yeah, I guess, Sebastian, the challenge is, we kind of, when it comes down to the equity markets in general, whether it's international, we just could be in for some volatile times. And I think the committee here should understand that, we have equity exposure, and, you just have to get comfortable enough to be riding through a little bit of potential massive volatility in the equity markets. And the problem is, if you cover yourself and get out and say, okay, I don't want to take any risks, then you miss a lot of the movement. We need to grow this. So I guess, Sebastian, what I'm saying, you may just want to give people on this call a little bit of, we could be in for a little bit of rough time if we're doing this as a long-term investment.
That's precisely right, John. So I think, at the end of the day, what you're seeing here, one, we have to raise cash for spending. I mean, that's just structurally something that we want to do at this meeting, irrespective of everything else that we spoke about. But two, from a positioning perspective, we went into 2022 thinking it was going to be volatile. We came into 2023 thinking we're going to see some volatility, and we're definitely seeing that. So absolutely, in the short term and the intermediate term until things settle a bit, there is an expectation for volatility to abound. The Vanguard trade is a way to, or the Vanguard recommendation, the short-term corporate bond, I should say, recommendation is a way to mitigate a little bit of that by really putting on a position that should not move as much with equity markets as if you were just fully exposed to equities, right? You're taking a trade that's giving you attractive yields, but not all the equity risk that's associated with it. So that's a little bit of a trade-off there. And I think the last point on this is that in the last year, you saw us come back to you with maybe one rebalancing recommendation. And if you think about what happened in 2022, both equities and fixed income sold off. So that historical correlation where if stocks move up, bonds tended to move down. If bonds moved up, stocks tended to move down, decoupled. So if we were looking at our portfolio on January 1 of 2022, and then looked at it and did nothing on December 31, 2022, we're pretty much in the same position because everything moved in a very, very tight line around that 60-40 allocation. Given the volatility that we're seeing today, and some of these things that are coming through, we think that there are going to be more chances to rebalance and buy that dip that just weren't there last year. But to John's point, ultimately, we do expect more choppiness in the market, more volatility. That may result in opportunities to rebalance. That doesn't mean we move away from our strategic allocation because over the long term, we believe this is appropriate. But where we can implement ideas to remove some of that volatility without necessarily removing the potential return, we want to also be able to recommend those as well. And that's sort of how Vanguard fits into this, or that short-term corporate bond exposure fits into the whole picture.
Okay, so I may sound, I'm sorry, but the math is not working for me. So I'm sorry if everybody else understands and I don't. If I see this, so we have 3.8 that we're taking out from the entire. I see that we're adding to the UBS and then having a new fund. Where did the rest go?
No, so if you add all the red numbers up, that will equal from a full flow or negative or withdrawal perspective, if you add all of the red numbers up, that would equal 6.1 million dollars, right?
Right.
So then you take your spend out of 3.872, and that leaves 2.1 million dollars to add to Vanguard.
I got it. Okay. Sorry, that's the part that I was missing.
Yep.
Okay, I got it. You
Yep,
take the
it's
distribution, and the difference of the distribution then gets reallocated.
exactly. That's
I got
exactly
it.
right.
Sorry, I need another cup of coffee. All right, got it. Too much math for early in the morning. Okay.
Overall percentages are staying the same within each category. So
That's precisely right.
We're not changing the policy.
Right, just adding a fund.
Right, and this is a very simple fund that can be bought right through BNY. So it's a simple implementation.
Okay.
And I will note that this is one where you will hear from us at some point in time to say this opportunity has dissipated completely. It's time to rebalance out of it. So this is not one where we expect it to be here for the next 10 years.
Got it. So we didn't have this as a vote, Pamela, but we need to take this as a vote, correct? To add a new fund.
Next page, I do have it as pending discussion that we may have a vote.
Oh, okay, got it.
Hey, can you forward it, Pat? I don't know if Sebastian's done with this presentation, but
I am. That's all I had for our presentation.
Jay, can you
Okay.
forward the slides for me?
Yeah, good work.
Ah, there we go.
Okay.
So any discussion, any questions for Sebastian? That was a lot of information.
Evelyn, may I ask one thing?
No, but there is.
I believe we're adding a money manager, and I do believe when we add a money manager, we take that vote to the full board, that you folks can reallocate within existing money managers, is my recollection.
Oh, so so this is a recommendation.
Right, it all depended on how we did
Yes.
with just the rebalance, and we didn't have to. If we're adding a money manager, then we do have to bring it to the full board. That's the difference.
Got it. So the vote changes to make a recommendation to the full board to add a new money manager.
Correct.
Got it. John, you had a question?
No, I'm good. I thought that was a good, solid presentation. So it makes sense, the reallocation. So just to get it back in line.
Mm-hmm. Mike, Najib?
I appreciate the presentation. Thank you.
All right.
Oh, hey, just one note, Sebastian, I don't know if anybody noticed, but his title has changed. I think he used to be a senior consultant. Now he is a partner.
Oh,
Oh,
congratulations.
congratulations, Sebastian.
I
Yes.
noticed that. Yeah, nice job.
Oh, look at that.
I
He's
appreciate it.
blushing.
Are you
I am
turning red,
blushing.
Sebastian? Oh,
Yeah, he's blushing.
You wouldn't have heard it from me, so I
Congratulations.
appreciate that. Thank you.
Oh, wow. Well deserved, Sebastian.
Well, I should.
deserved. Sure.
Alex is a member of the team as well. I think this is the first time you're meeting her, but she was promoted to consultant as well. So kudos all around.
Congratulations.
There you go, Alex.
Thank you. Pleasure to meet you guys. I'm excited to work with you more.
All right.
Great.
Awesome. All right. So let's take a vote. And this vote changes to make a recommendation to the full board to rebalance and add a new fund manager, Vanguard Short Corporate. So with that, can I get a motion?
So moved.
Second?
Second. Yes, second.
Evelyn, if I could do a roll call for this vote, just because.
Absolutely. Go ahead.
Garano Ortiz,
Yes.
Bob,
Yes.
Tyler,
Yes.
Leonard,
Yes.
and Rush.
Yes.
Thank you.
All right. All set. So Sebastian and Alex, thank you for joining us. You may drop or you can stay, whatever is your fancy.
We'll drop
Appreciate
off. Thank you,
All right.
everyone.
Have a great day,
Appreciate
everybody.
the information.
Bye-bye
Thank you.
I live in New Hampshire, so I can tell you if it's not snowing yet, we've got about 4 or 5 inches on the ground already. So it's
No,
coming in.
coming. It's
Yes.
coming.
Thanks,
Yeah.
everyone. Bye-bye.
Bye-bye.
Take care.
All right. Ellen, let's
Yes.
talk about the camera.
Okay, and we have Eben in the waiting room too, in case there are any detailed questions. But essentially, this is a request from Eben English and the digital services team. It is a camera that will augment their digitization capacity, so they're just looking for another camera. It's a highly specialized camera, and we have found one vendor that we can purchase from. So we're requesting authorization to go with this company, for Digital Transitions Inc. For this camera.
Is that the one? Is that the one that has the lens on top and then you put the book on the bottom and then you flip and it takes the pictures? That
I
one?
believe so, but we can turn on Eben's mic if necessary.
Let's have Evan.
So it's down. If folks have been downstairs to the lower level by RAB, they use them down there.
Jay, can you open up Evan's microphone for us?
There he is. Morning, Eben.
Good
Good
morning,
morning.
everyone.
Good morning, Evan. Evan, is that the camera? The one that goes on the top and then you put the book on the bottom and then you flip and it takes pictures? Is that the one?
Essentially, yeah. So the camera is mounted above the item that you're taking the image of. In this case, this camera would be used for imaging large format materials like maps, posters, artwork, prints, architectural drawings, things of that nature. So
Oh, so it sits up higher so it can take a.
right. It
there.
has it takes a much larger image intended for large format materials in this case.
All right. Questions, anyone? No questions? All right, so now I'm going to encourage everybody to go and visit the digitization section because it's quite cool. I've been there. So I encourage you also, you can see how these cameras work. They're pretty awesome.
Yeah,
All right.
absolutely. We'd love to have any in and all visitors.
There you go.
Maybe when we're back in person, we can swing through coming out of KBLIC since they're right there.
Mhm. All
Yeah,
right.
David, remember David, years ago, you took me on a tour, one-on-one tour, and I get to see, it was unbelievable. It really was so cool.
And
Yeah.
it just goes from strength to strength as we build out the team and do more, not just for our own collections, but for our statewide partners and the Commonwealth as well. So it's now an essential, not an optional service. It's an essential part of what we do.
Mhm. All right. Any questions for Evan?
More question for Ellen, just the source of funding for this, Ellen, is the
Sure.
library.
For digital services, often we would use unrestricted revenue such as event money, but we do believe there is sufficient money in LFC, the Library for the Commonwealth, I should say, funding for this year.
Okay,
So we have ample funding for it.
great.
Which makes sense given that statewide digitization is one of the purposes of that program funding.
Mhm. All right. Any further questions? If not, we're going to take it for a vote. All right. Can I get a motion?
So moved.
Second?
Second,
Do you need a roll call?
If you
Pamela?
don't mind, yes, for these votes when we're virtual, I do.
Okay, go.
Arana Ortiz,
Yes.
Val,
Yes,
Tyler, can you give me a thumbs up?
Yes.
Yes, all right, thank you. Leonard
yes.
and Rush.
Yes,
Next slide, Jay.
Oh, no tax returns.
So the tax returns, just a quick update on the tax returns. So we don't typically ask for a vote on the tax returns because it is based upon the audit that the trustees review and approve in September. So it is essentially taking that data and restating it in the 990 form. So while I'm happy to take questions or any questions folks might have, we do not typically take a vote on it simply because it is a restatement.
Right. Any questions about the 990s? No questions? Okay. New business, anything, any topic, any flybys? Nada.
Next
All
slide.
right.
Jay.
that it, Pamela? No? Okay.
Sure.
Public comment. Do we have any comments from the public?
If we could just open up Priscilla Douglas's microphone for me, Jay, she just wanted to thank the committee. Thank you.
Hello, everybody. It's so good to see you, and thank you so much for your collective wisdom. What the perfectly timed meeting and report by our consultant to help us to guide us through this tumultuous time. So I'm just thanking you. Thank you, Evelyn, for your leadership. You can make financing fun. And thank you all.
I appreciate that. Especially when I can't do math. All right. All right. So if there's no further comment, we adjourn. And the next meeting, it's in May. All right.
Thank you, everybody.
Thank you.
Thank you
Thank you.
all.
Bye-bye.
Thank you.
All right. Don't break your backs. Bye.
Thank you, Jay.